So you've heard the names, right? Bitcoin, Ethereum. They're the two undisputed giants of the crypto world. But let's be honest, beyond the headlines, the actual differences can get kind of blurry. One gets called digital gold, the other a world computer. We're going to break down what that really means.
At the heart of it, these two analogies are everything. Think about Bitcoin as a store of value, completely outside the control of any government or bank. It's like gold, but for the digital age. And then you have Ethereum. It took the same core blockchain idea and basically asked, okay, cool, but what else can we do with this? It wasn't built just to be money. It was built to be a global, programmable platform, the foundation for a whole new internet.
Okay, so that's the big picture. But how do those totally different philosophies actually play out in the real world? What's going on under the hood? Let's get into it.
To really understand this, we're going to look at 6 key areas. We'll kick things off with Bitcoin's origin story, then dive into how Ethereum evolved from that. We'll put their tech head-to-head, unpack their completely different ideas about money, see how investors look at them, and finally, check out what's on the roadmap for both.
All right, first up, Bitcoin. You just can't talk about crypto without starting right here. This is the one that kicked the whole thing off, the OG.
Back in January 2009, the mysterious Satoshi Nakamoto launched this thing with a pretty radical idea, a peer-to-peer electronic cash system that didn't need a bank. Then key moments like the first halving in 2012 started to programmatically make it scarce. By 2017, it absolutely exploded into the mainstream. And more recently, you've got upgrades like Taproot, which started adding some basic smart contract features. Code that automatically runs when certain conditions are met.
And that really gets to its core purpose today. While it started as this idea for digital cash, it has really become a store of value. People see it as digital gold, a way to park your wealth that isn't tied to any government's decisions, a hedge against inflation, existing completely outside the traditional system.
So Bitcoin proved this whole decentralized thing could work. And then a lot of smart people started thinking, what else could we build on a blockchain? And that's exactly where Ethereum comes into the story.
Ethereum isn't trying to be a better money. It's trying to be a global computer. It's a platform where developers can build and run these things called smart contracts and decentralized apps, or dApps. Think of them like the apps on your phone, but they run on a blockchain, not on a server owned by a single company. This is the bedrock of what people call Web 3.
And that means its token, Ether or ETH, has a bunch of different jobs. Yeah, sure, you can trade it and invest in it just like Bitcoin, but here's the key difference. It's also the fuel that powers the network. Every time you want to do something on Ethereum, run an app, make a transaction, you have to pay a transaction fee called gas in ETH. That utility is baked right into its DNA.
Now, because their goals are so different, their technology is completely different too. This is where you can really see that we're talking about two very distinct machines built for totally separate jobs.
The biggest split is how they agree on what's true, their consensus mechanism. Bitcoin uses proof of work. You can picture it as a huge, constant race where powerful computers, called miners, compete to solve a complex math problem. The first one to solve it gets to add the next batch of transactions to the blockchain. Ethereum, though, moved to proof of stake. Instead of a race, validators lock up their own ETH as collateral. It basically replaces brute force computation with an economic incentive to act honestly.
And the real-world impact of that switch is just massive. For years, the biggest knock against proof of work was its insane energy consumption. By switching to proof of stake, Ethereum slashed its energy use, basically overnight, tackling one of the industry's biggest criticisms head-on.
You can also see the design difference in their performance. A new block gets added to Bitcoin about every 10 minutes. On Ethereum, it's about every 12 seconds. That means in one day, Ethereum processes way more blocks. And that speed is crucial because Ethereum's blocks aren't just carrying transaction data, they're carrying code that can be executed.
Okay, let's talk about the money, because the economic policies behind Bitcoin and Ethereum are night and day different. And it's a huge reason why people invest in them for completely different reasons.
With Bitcoin, it all comes down to this one single number, 21 million.
That's it. That is the absolute maximum number of Bitcoins that will ever be created, and it's written right into the code. This fixed supply is the entire foundation of the digital gold argument. And the rate new coins are created gets cut in half about every 4 years. That's the halving. It's designed to be predictably, verifiably scarce.
Ethereum, on the other hand, well, it doesn't have a fixed supply cap.
Its policy is much more flexible, because its main goal is to make sure the network is secure and useful, not to create a perfectly scarce asset.
And that, of course, brings up the million-dollar question that everybody asks. If there's no cap, what stops the supply from just inflating forever and becoming worthless?
Well, here's the super interesting part. A huge upgrade introduced something called a fee burn. Now, a portion of the fee from every single transaction on Ethereum gets permanently destroyed. It's burned out of existence. This means when the network is really busy and a lot of people are paying fees, more ETH can actually be burned than is created. So the supply can actually become deflationary.
So you've got these completely different technologies and economic models. It's no surprise that investors, from you and me all the way up to huge institutions, think about these two assets in very different ways.
Here's a cool example. The investment firm VanEck did a historical study. They looked back from 2015 to 2024 and asked, if you had a crypto-only portfolio, what mix would have given you the best risk-adjusted returns? And the answer they found was about 71% Bitcoin and 29% Ethereum. Now, this is just a historical look back, not advice, but it shows you how analysts think. Bitcoin often plays the role of a more stable digital gold-like anchor, while Ethereum gives you exposure to the high-growth, high-potential world of Web3 and dApps.
So finally, let's look to the future. Both of these networks are still very much a work in progress, but, surprise, surprise, their development roadmaps point in completely different directions.
Ethereum has this very ambitious public roadmap with a clear goal: massive scale and efficiency. Upgrades like Dencun have already made transactions on secondary networks way cheaper. And future stages with cool names like the Verge, the Purge, and the Splurge are all about making the network even faster, cheaper, and more decentralized, with this wild goal of handling over 100,000 transactions per second. Bitcoin's development, on the other hand, is much more conservative, prioritizing extreme stability and security above all else.
So what's the big takeaway here? You've got two projects that came from the same spark of an idea, but they have wildly different destinies. One is becoming this pure, decentralized store of value. The other is expanding to become the base layer for a whole new digital economy. And that leaves us with the ultimate question. Are they just competitors in a winner-take-all fight? Or are they actually two complementary pillars building a digital future that needs both a new kind of gold and a new kind of computer?